Hey, everybody, it's Hammer, and I am here this week for your mortgage market update here at Vetted VA. And joining me this week, we have a guest again. We've got Scott Valins. Scott, thanks for joining us. Glad to have you here today. Uh, Please
Good
go
to be
ahead
here.
and take a minute and tell everybody a little bit about yourself.
Sure. Very happy to be here. I love talking markets, MBS, treasuries, all that fun stuff. My name is Scott Valins. I'm the broker owner of Go Rascal. We're based here in Brooklyn, New York. I'm a proud member of Vetted VA, VVA 3. Yeah, that's basically it. Been a mortgage broker my whole career, 20 years now. It's the only channel I've ever been a part of. Proud of that as well. And love what I do.
Awesome. So you're in Brooklyn, huh?
Yeah. Yep.
My
Those are real walls behind there.
my future son-in-law proposed to my daughter on the Brooklyn Bridge.
I'm sure
That
they
was
put
the
one of those
site of the
locks in the fence as
they
well.
they did, and it was cut off. Yep.
Exactly.
Before the bridge
Eventually.
falls down.
Exactly. Right.
Yeah. So awesome. Well, if you guys are here today, please go ahead and let us know. If you're here live, say hello. I see that we've got quite a few of you that are actually on already. Say hi in the comments. Let us know if you're a consumer. Let me know if you're a mortgage professional. We'd certainly love to hear from you. Remember, if you're watching on the replay, do us a favor. Give us a hashtag replay. Let us know that you were here. I know many of you can't join us live. However, you do like to get the information each week, see where rates are at, get a kind of an agnostic view with no dog in the show of where things are going and how that looks. And Scott, since you like MBS and everyone else is like, and what? Mortgage-backed securities. It's actually the basis of where mortgage rates come from. So since Scott is an MBS junkie, we're going to actually go a little deeper on that later today. So we'll do a quick rate recap. We'll do a quick rate forecast, and then we'll go deeper and we'll talk about why do mortgage rates move, what's happening next week with the Fed, why we think rates are going to move when that does happen, and we'll take it from there. So if you guys have any questions or comments, remember, we always do love to hear them. Let's see who's said. I see somebody who's a consumer. If you'd like to share your name, let us know. But otherwise, if you have any questions, definitely, reach out and let us know here. So doing a quick rate recap, let me go ahead and bring my slide up here. So doing a quick rate recap, basically rates are just slightly worse in the smallest sense from last week. So last Wednesday, we saw some of the best rates on most average rate sheets. And remember, when we talk about this stuff, this is not an offer to lend. And when we talk about rates, we're talking about averages and generalities. You should always shop around and find a rate that works for you. So if you are shopping around, if you find VA rates that are in the high fives or low sixes, that's going to be very much where the market is. What about for you, Scott, in New York? What are you finding for rates right now for VA rates? Are they in that 5s to 6 range, depending on credit score and such?
Yeah, I mean, New York, we have, it's funky. In New York, there's a 1/4 of a point hit that most lenders put on because they have to pay that as part of the New York mortgage transfer tax. When a borrower
Yep.
gets charged transfer tax, the lender's responsible for 1/4. Most of them pass it through. So our rates might be, some don't, might be a 1/4, but that's a 1/4 in fees, not in rate. So it still
Right.
keeps the rates generally in that. Yeah, we've been pretty comfortably under 6 for a little stretch here. With no points. So yeah, I think you're spot on there.
Yeah, so if you're getting rate quotes in the high fives and low sixes, that's very much what the market is showing right now. As far as conventional rates, if for some reason you're not getting a VA loan, conventional rates have been in the low to mid sixes. When I say low, could be as low as 6.125 and maybe low as 6.25. It depends on your situation. There are some changes that you guys are, as consumers, you're going to be finding that rates are going to get a little more expensive over the few upcoming weeks. That's coming down from the Federal Housing Administration, the FHMC, even I'm getting alphabet
FHFA.
soup. Thank you, FHFA, because you know what I had in my brain is Fannie Mae and Freddie Mac, FHL for Freddie Mac.
Right,
So
right.
Fannie Mae and Freddie Mac
Too many
are
acronyms.
Oh, they are, right? So they are actually making some adjustments on how much they are passing along on the consumer side. So we'll talk a little bit more about that in a minute as well. Otherwise, things that we've seen, inflation continues cooling. That's a good sign. we're seeing more recession concerns and more recession headlines. Recessions are generally good for mortgage rates in the housing market, y'all. It may seem kind of anti the rest of the economy, and it often is. As mortgage professionals, we get torn because we're like, yeah, people are losing their jobs. Wait a minute, people are losing their jobs.
Yeah.
And but that's what usually helps mortgage rates improve and things like that. So it's a double-edged sword. So but we are seeing that. And as far as where are things going from here, let's do a quick rate forecast and just again give everybody a little bit of an idea of where we're going from here. Rates are going to very much over the next week. I expect them to remain near those current levels. Whatever rate quote you're getting now, you shouldn't see too much movement. If you're out there shopping, you shouldn't have to worry about big rate jumps like we've seen in the past, where you wake up one morning and rates have been 0.5% higher. We don't expect anything crazy like that between now and next week. And we're not likely to see much improvement between now and next week's Fed meeting, but we're also not likely to see too much of a risk of rates getting higher. It's kind of a, status quo. Day-to-day rates will change a little bit, and Scott and I are going to dig deeper and show you why that happens. But overall, I don't think we're going to see much of a move on that. What do you think, Scott? What is your opinion on where do you think rates are going to go between now and next week, for as an example?
I mean, I think I agree with you. I guess there's an inflation report coming out Friday, right? It's not the big CPI reading. It's
Right, you get the PCE, which is the personal consumption expenditures. But what'll happen? It covers the same time period as the CPI report that we've already seen. So we would expect to see data that's very similar, showing inflation is
totally,
cooling. And
totally.
even though the Fed and the we'll circle back on this, the Fed is really what's driving mortgage rates right now, and I'll explain that statement. Even though the Fed, the PCE is their favorite gauge of inflation, it really isn't expected to be any different than the CPI, and that's why we're not seeing a big. I don't expect to see a big reaction to it on Friday. We haven't the last 3 months actually, so it's really should stay along those lines. But
Totally.
otherwise, yeah. Anything else that you would talk about on that?
No, I mean, I think there's this week's there's it's an auction week, so we talk about that. Sometimes that can move, within the same day. You could see some
Mhm.
movement around the auction, and there could be a continuation through the end of that day. But oftentimes, we'll get it back the next day if there's nothing else that's a big market mover. But
Right.
no, I mean, Fed meeting is big here because you've got the inflation numbers that look really favorable to us, but you've got this Fed speak of them staying pat and saying it's not good enough and we need to see more and we're going to keep raising and keep rates higher and all that. And so I think the markets all have heard that. So I agree with you. I think we're in a pretty good spot here, and hopefully there's not any surprises that you and I aren't aware of going
Yeah,
into
yeah,
next week.
yeah. So we'll definitely let's circle up. We'll talk about those auctions. We'll talk about the Fed. We'll talk about where rates come from. Let's go ahead and address this question. It says we locked at 6.25% with a one-time buy down. When you say a one-time buy down, generally you're paying points to get the rate lower. Is there an amount that you paid on that? Let me know in the comments if you're watching, so we can get an idea of that. We have the option to unlock our rate, and we won't be able to lock for another 30 days. Should we close on our home as a new build? We should close on our home as a new build at the end of March. So that's about 2 months from now. And should we unlock the rate? Well, I'll give my opinion, but I've done a lot of talking. Scott, why don't you go ahead and share what you as a mortgage professional, what your point of view is on this?
I wouldn't unlock. I think we've seen a nice recovery in rates from our worst levels, and I think like another significant leg down could come, but we also could. I've told everyone, my loan officers, whatever, it's going to be a bumpy path lower. We've moved higher in a few days earlier this week. We're back down again, but 30 days is not a lot of time, and I feel like you unlock your rate and then you got to also consider the stress levels of, all right, we're back to floating again. Every single day you're going, no, 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 is it better or it's worse? Even if you can't lock it again for 30 days, I think you keep your lock. You have a one-time buy down in your pocket. That's probably going to cost you a little bit something. Might be a free buy down. I'd be surprised if it's a conventional loan. There's probably a little cost there, but because you have a buy down option, I would probably keep it locked. Otherwise, it feels like just true gambling.
Yeah, I'm going to move this over. I'm going to pop this up. So, all right. So you paid 1%. And then that's the follow-up question to that. The answer of, did you pay to receive that rate was 1%. And then the follow-up question was, how much is your loan amount? So, and if you want to put that in the comments, that would be great. It's a VA loan. And then I'm going to go ahead and pull up my screen while we go through this. So when you talk about, let's talk about what makes a good rate. And in this particular situation, so we looked at 6.25%. And when you talk about in order a buy down, let's see, they've given some new, there you go, cool new features
All
here
right, so
on
it's
the
a jumbo
Remarkable.
VA,
All right,
948 loan amount.
So a buy down equals that you're paying to reduce the rate. And in this scenario we're doing, it was 1%. So if it's 1% of that loan amount, if the loan amount is 948,000, that means that 1 point was $9,480. Now, if you if you've locked in, I've never heard of the ability to unlock, to be quite honest. Scott,
Same.
have you heard of that? As to say, yeah, that's not usually
No.
something that. Okay.
And I obviously misunderstood. I thought that was a float down when they said buy down. So they paid the one-time buy down. What does it mean by a one-time buy down? That part's a little confusing.
Just give us a little bit on that and let us know when
Yeah.
you say with a one-time buy down, does that mean that you get the opportunity one time to float down to a lower interest rate?
Right.
Or does that mean that you paid that one-time fee of $9,480 to get 6.25%? So first things first, when, as far as is that a good rate, it's definitely in the ballpark. It could be based on what state you're in, your unique situation and credit score. As far as where to go from there, though, here's the thing. So all right, so you get the option to float down one time. Okay. So if you get the option to float down one time, then you're locked in at 6.25%. And what that does is that forms a roof. That gives you a cap. I know that my drawing skills are terrible. I wish I was an artist. So your cap is 6.25%. That's the highest interest rate that you're going to close at. And based on what you're sharing from how I'm absorbing this, and Scott, correct me if you see it a little differently and you're like, Hammer, no, I think he means this, or I think they mean this. But 6.25 is your worst case. And that's a great worst case right now. Much better than the sevens we saw a couple of months ago, right? So, but I do think that if you're closing between now and the end of March, if you get one bite at the apple and you do get the opportunity to go ahead and you get one time to say, okay, I'm going to click, let's click the box. I'm going to take the interest rate where it's at today. I do think between now and the end of March, you would have an opportunity to get an interest rate that's below 6.12 or 6.25%. I think you'll see lower rates than where you're at today between now and the end of March. And I'll show you why. Marita. Okay. So thank you, Marita. So this is Marita's question.
She also pointed out that I don't want to interrupt, but she did also make it clear that they could kill the lock today and relock at market in 30 days, which isn't, that part's not so uncommon. It's like, all right, we're going to kill your lock now. You're floating, but you can't lock for 30 days. So that makes sense. Understood.
Yeah. So if you have a float down option, keep that option open. And what we're looking at, let me go ahead and change screens here. So this is what's called a Fed Watch tool. This is basically what we call Fed futures. So what's currently driving mortgage rates, and let me go back to my drawing pad, and Scott and I can kind of go a little deeper on this one. We'll be a little longer, Scott, but I want to try to keep us as close as I can to try to ending by 12:30. But your mortgage rates, they're based on what we call mortgage-backed securities, or MBS is what Scott called them before. And that's these fancy charts here. Now, Scott, I'm usually the guy that tells everybody what all this stuff means, but you look at the same charts that I'm looking at right here every day. Do you want to take a minute and just kind of explain to everybody what we're looking at?
Sure. Yeah. MBS, they're bonds. They're bonds that people buy and sell on Wall Street the same way they buy and sell U.S. Treasury bonds. These are mortgage bonds, and they're essentially a numerical indication of all these loans that we close at different interest rates. They get packaged up, and people can buy them on Wall Street and earn interest on your loans. They're effectively buying pieces of all the loans that we write as mortgage brokers. And when they're traded, the value of that bond can go up and down. And we like when the value of the mortgage bond goes up, when it's green, when it's going up, because that means the interest rates that we can publish to the consumers are improving. I'll kind of keep it simple as that. Don't want to get too technical about that, but this is the exact indication of whether we can share better or worse rates with you on a day-to-day level. And they're tied to the US Treasury bonds, which is a different instrument, and they generally move in the effectively the right direction. Well, inversely, but anyway, I'll stick with the mortgage-backed securities. Green is good. We want them to go up in value, and that's what we look at every day to tell you whether we have better or worse interest rates compared to the day before.
Right. So, Marita, what we would be looking at is this is our baseline. This is where your basic, where everybody is going to experience rates moving up or down. And that's going to be based on what's happening here in the bond market, because that gets passed along by Freddie Mac and Fannie Mae. The margin is what your lender has to charge in order to make a profit, process the loan, keep the doors open, the lights on, pay their staff, etc. So you can have some lenders that are making more or less profit, and that's why you see variations on rates between one lender and the next lender. Is generally that's their margin, but almost everybody is going to be dealing with the same thing. And in fact, in this case, it's not this particular bond that we're looking at called the UMBS. It's actually a Ginnie Mae bond, which is for VA loans, and this is where VA loans are sold. So what happens, as Scott said, when we see these green candlesticks, these are good days. These are days that are good for your rates generally, but we're looking at the trend. And I'm going to change this chart to what we call as a line chart. And if you see it's an inverse relationship, if you see this go down, that means your mortgage rates actually went up a little bit. If you see this go up, that means your mortgage rates improve a little bit. It may not be the interest rate itself. It may be the credit or the rebate that you're receiving towards your closing costs. So overall, basically what we have to ask in your situation is, if we go back and we look at this for 6 months, if you're locking in your interest rate at 6.25%, do we think that this line is going to go up and improve between now and March? And do we think that these mortgage bonds are going to be basically trading for more money? And why would that happen? So in a very oversimplified explanation, the reason that these mortgage bonds will trade for more money is that as the economy slows down and we fall into what is most likely going to be looked back on and reflected on and called a recession, we're going to see that these bonds are, for portfolio purposes, for your trading, they're going to have more value, because stocks tend to lose a lot more in a recession, and bonds are generally the instrument that you can weather the storm. So we're likely to see these improve over those next couple of months. If you do have a float down option, you may find that you take it sometime as you get closer to closing. And in your situation, it's most likely that you'll see rates improve as you get very, very close to closing. So what's going to happen is we're monitoring what the Fed is doing right now. And the Fed, they're going to meet in a week, and they're going to come out and they're going to adjust what's called the Fed funds rate. Now, when they adjust that Fed funds rate, they're going to raise it, and they're going to raise it what's currently expected by an overwhelming belief of 98% to be at 0.25%. So when they raise that Fed funds rate, it's not going to raise mortgage rates. The reason that it's not going to raise mortgage rates is because mortgage rates and traders in the markets have already anticipated this move, and they've priced it in. So as long as it happens as we expect, and it's overwhelmingly expected to be 0.25%, mortgage rates would actually stay stable, maybe even improve a little bit. Now, that's why, because mortgage rates are actually reacting to what's going to happen. We're forecasting, not to what is happening. So we're looking at March, and then we look at May and June, and these are all future meetings of the Fed. The Fed meets approximately every 6 weeks, and we look at these meetings and we're forecasting, where is that Fed funds rate going to be? The higher that Fed funds rate is anticipated to be, mortgage rates would actually move higher now. However, what we're seeing is that there's a very strong expectation that the Fed is going to raise rates at the February meeting, the meeting in a week, like we said. Once again in March, that'll bring rates up to 4.75 for that Fed funds rate. And then at that point, they're likely to stop. And the Fed has been raising rates now for over, it's over a year now. It's or coming up on a year. March, I think, was the first. March of 2022 was their first interest rate hike. And so by the time we get to that March meeting, it's going to have been a year. And it's likely that they're going to pause because they're starting to see signs of the economy cooling off. Inflation is improving. And that's the reason that they're raising these rates is basically it throttles the market. It makes borrowing more expensive. It slows down commerce. It has consumers spending less money. And that's going to help to cool off inflation. Once the Fed gets that happening, because we all know inflation is a problem. We've talked about this before. As long as inflation gets back in check, now the Fed is going to be free to, at some point, they're going to start lowering that rate because they're going to need to resuscitate the economy. And right now, the expectation is that we're going to see that sometime around November. So the reason that you may see better rates in March is that we're going to have more information. We're going to be closer to that November timeframe, and markets and traders are going to adjust their expectation. What do they think the Fed is going to do 6 months from now, 8 months from now? And that could actually help your mortgage rates as we move closer to March. Scott, what would you like to add on that or say about that?
Yeah, it's great and very, very good detailed stuff. I would say the only devil's advocate here is we have 2 jobs reports between now and the end of March, right? We have February, which will be January's report, and in early March, right? It's the first Friday of every month. And the 2 things the Fed still sees and is paying attention to that they want to see get worse before they'll start to really say, okay, the economy has cooled off enough, is just the amount of jobs that are available, the amount of jobs people have. Frankly, they want the unemployment rate to be a little bit higher, and wage growth. Those things have still remained a bit stronger than the Fed has hoped for in every jobs report we've had for a long time now. I think the last jobs report, wage growth came down a bit,
It did. It
which
was
was promising for us, but still 250, 300,000 jobs. So you have 2 reports. Listen, if the next job report is close to 0 jobs or we see a real pullback in wage growth, I think you see a real response in the mortgage rate market, because that's the last remaining thing that the Fed's basically saying, hey, we want to really see this get worse for us to feel like we're accomplishing what we want to accomplish with these higher rates. So I think we're due for those to get worse. They've been pretty sticky for a while, but just a little 2 other economic pieces that I wanted to throw in there.
Yeah, no, and you're right on both of those. It's a great addition, Scott. Now, Marita, one thing to realize is that when we anticipate rates could improve between now and March, it's not likely to be dramatic improvements. Remember, we're coming from pandemic rates of 2 or 3%. That's not going to happen again. And when I say not, I'm pretty emphatic about that. It was because of the response that we had in shutting down the economy over COVID. It's the only reason that we had those rates. They were artificially created. They were manipulated through the markets, through the Fed. So we're not going to see those rates again. We may see rates in the 4s one day, but more likely this year, we're going to see rates in the 5s. Now, if you close between now and March and you close at 6.25, and let's say that through 2023, rates do go down, remember, you're getting a VA loan, and that VA loan has a wonderful, wonderful benefit to it. It's called the EARL. So you have an opportunity to go ahead and do what's called an interest rate rapid refinance loan on a VA mortgage. Now, there are some requirements. Number one, you've got to actually save some pretty significant money. Rate generally has to go down. I think it's about 0.5%, right, Scott, for an EARL?
Yep.
Okay. So, and what an EARL is that you'll be able to speed up that refinance process. You probably will not need an appraisal. They can sometimes change the rules, but generally you don't need the appraisal on that. You don't need to requalify with all the same things. You just need to prove that you're still employed, those kinds of things. And you'll be able to get this. And what happens, you need to make 6 payments, and you have to wait 210 days. So it's, that's basically your rules behind it to when you can qualify for an EARL. So even if you get 6.25 and you do see rates moving down in April, May, June, don't panic, because most likely by that end of 2023 is probably when we'll see the lowest rates, or within that range of the lowest rates we're likely to see, and you'll have an opportunity to refinance then. So keep that in mind. And this also reduces your fees when you do an EARL. So, but as far as closing between now and the end of March, getting the opportunity, I wouldn't jump when rates move just a little bit. I would wait until very close to March, to your March deadline. I think that's when you're going to see some of those better rates we're anticipating to see if rates do move down. That, as Scott said, if we see labor numbers that come into play that help us, if we see inflation continue each month, we've seen 3 inflation readings in a row now that have been what's called disinflationary. Remember, disinflation means the rate of inflation is reducing. It's not deflation. Deflation is the price of goods coming down. So even if we see more disinflation, that's going to be a good sign. And that's why you would see some improvement there. So hopefully you found some help from that, Marita. Anything you would add, Scott, for Marita to kind of give her that?
Yeah, what's the one-time buy down cost? It's traditionally like a 0.5%.
Well,
That
I
if
think
you
that's why
don't,
she said it was one. I
or
think
float
it's the
down.
1%
Sorry, the
is.
float down. Oh, that's her float down cost.
Yeah. I think that.
Okay.
So yeah, so I mean, like, that's, would I unlock now? That's problematic, because I'll tell you what happens is let me show you this chart real quick, by the way. When we do that Fed futures, if we see this move, which it does, like, I'm going to click compare, and you'll see that a month ago, we can go back a month, we can go back a week, and we can go back a day. And a month ago, the expectation was that we were going to see a 0.5%, or see the Fed funds rate go up to 5% rather. But yet now that expectation is much stronger, that will be at 4.75. Well, if we move back in this direction, where markets are concerned that the Fed will have to raise rates more aggressively or hold that rate higher for a longer period of time, you're going to see mortgage rates go up from that 6.25. So there is a risk of seeing your rate move higher if you do unlock it.
I guess, Hammer.
Yeah, go ahead.
Yeah, I agree with that. My only slight concern is a 1% float down fee in this market almost equates to about a 0.5% in rate, right? With margin compression and everything. So, if she does end up floating down, the cost to float down might end up, I don't know. It's
right. If you were to refinance,
it's a real fee. It's a real fee.
Remember, you're spending that money today, Marita, and if you were to refinance your loan in, let's say, 8 months or a year, that money is gone. So you don't have any time of recovery on that money. So just factor that in. If it were me personally, if I'm going from 6.25 to 6%, I wouldn't pay that 1% to get the float down. This is a strictly opinion. It's a mathematical equation that you have to decide. But for me, I wouldn't do it if it were me, because my opinion is I think rates will come down more significantly over time. I wouldn't want to lay out that money now knowing that I'm not going to have enough time to recover it. Whereas when I took my mortgage on my current home in 2017, I paid $800 in fees to get my interest rate about 0.25% better. And I've been in that loan for 5 years. I've made that $800 back because of that 0.25% savings. So, Scott, what you were nodding your head, what would you add to that?
Yeah. What state are you in? Because if you're in a low closing cost state in general, for example, California happens to have a low closing cost, just has generally low closing costs. That, to me, that would say don't pay the 1 point, because if rates go from 6.25 to 5.75 in 8 months from now, you didn't pay the 1% upfront fee, like you mentioned, Hammer, and now you're not paying much to close the URL at a 0.5% lower. If you're in a state that is Virginia's a pretty low closing cost state, and so, like Hammer was saying, you pay that 1% at some point in the next 30, 60 days.
And that holds you in.
It's going to be something. It holds you into that loan, because you're going to think 8, 10, 12 months from now, I paid so much to get this rate, I'm going to wait longer, and then you're going to miss out on the lower rate. So
and calculate that.
I almost say cut the flip, like kill the lock now or ride it out, unless miraculously the rates drop like 1% between now and the end of March.
Right. And we can't, that's the forecasting part that we don't know. That's where we shake the magic 8 ball. It's unlikely, but it's possible. And that would be the only scenario, I agree with Scott, where it would make a significant savings. What you want to do is calculate out your difference in the payment based on the interest rate, look at the amount that it's going to cost you, and then just divide that amount by the savings each month, and you'll know how many months it's going to take you to recover. And generally it's going to be about 3, 4, 5 years to recover that money. Often not, especially unless you're going to keep that loan for 5 years, that means that you don't think interest rates are possibly going to move lower for 5 years, or that you're going to move in 5 years. So paying points, it has a benefit, but in this market, I'm not a big proponent of it. like I would have been if we were talking about rates at 2.5%. And it's like, we're never going to see rates this low again. Pay the point, bring it down. You're never going to refinance, so that's kind of the difference. But congratulations either way. Don't let this stuff drive you crazy. We want to try to help you, but once you get to that point, and if you're locked in, sleep well at night. You're getting a home. Congratulations. You're going to find appreciation over the next few years is going to be a big benefit. You're building equity. Plus, you get to paint the walls any color you want. That is the best part about owning a home. So I think it's the best part. Anything,
That'll
Scott,
be on
that you
our.
wanna-
We'll talk about more about that on our home design show, airing at 4:00.
That was like the worst thing to me about when I rented. It's like you were never allowed to paint the walls. I'm like, oh, these walls are terrible. I'm like, I can't even do anything. I can't even paint the walls. So, all right. Well,
Yeah.
Scott, thank you again for joining us. Is there anything you wanted to leave everybody with before we wrap it up for today?
No, that's really it. I appreciate the people who like to pay attention to this and pay close attention to the rate and the markets. I think some consumers don't care and they just rely on their loan officer to tell them how it is. Those that do, it's fun talking shop with them. And
Yeah.
this has been great. Thanks for having me on.
And Marita, thank you for being so interactive today and giving us something to talk about and chat about with your unique situation. If anyone else would ever like to do that, you can go ahead and make a post make a comment in the post. We do monitor them all week. You're welcome to join us each week as we do this. Here's my little banner and it says, join me next week. Hold on. I got it up here. Where is it? I got this drop down over here. I got to find it. There it is. It says, join us next week. There you are. And I even got the times over here. Let me pop that up. There we go. So, all right. So you can go ahead and join us next week. We do this 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And again, Scott, it has been a pleasure. Thank you for joining me, my friend. And everybody, take care.
Bye, guys.